on when it is, when the crossover occurred. The big difference here is that we try to trade with the trend, right? We try to trade, let the dots pull away from the trend and then look for the pullback, because it's the very act of the dots spreading out which tells us the market's actually moving. Now you can see in this case it's spread out. Here's a pullback, but we didn't have a good spread oscillator right here, did we? And that tells you this was less likely to go down. Now remember, we never know what trades are going to work, and who does? But we know what the charts look like before they go down. Okay, watch it here now. That's not bad. Let's take that short. Oh, geez, did we miss it? Yeah, I think we might have missed it. It went pretty quick here. Bar close right here was, oh boy, see how quick that went? See, we're already into the trade. Yeah, see how quick that spread went? Yeah, and what will happen is you'll get used to trading this on the fly, although things happen very quick. See, we went 10 ticks, we're break even now. Let's see if we can stay alive here. Now, usually once we go break even, and how do you know how far to go out to break even? Your stats will tell you that. You'll come in here and record. You'll be able to record the trades. Yeah, look at this one, came back. Okay, so we got a nickel and dime there, that's fine. So we get a 5, then we get a 5 and a 10, so we have 20 ticks here. What does that equal? 20 ticks? Yeah, 20 ticks times $12.50 a tick. Yeah, it's $250 just on those two trades right there. That's not bad. Now, we're not saying that, trading is easy. We're not saying that you have to, certainly have to pay attention when you're here. Here's a crossover, you can see. Does that mean we want to take this long? Well, not really. I think once the trend is established, we really want to learn to trade with the trend. We have some shading on the MCD indicator here, which suggests possible chop in the market or possible reversal. Now, some people get pretty fancy with this, where they see as soon as the market flips back and you start get these opposite green color bars, they see this histogram starting to crank back, and they'll get right on it. They'll get right on this, on the full opposite color bar here. Yeah, we don't need to trade that aggressively here, especially after you catch some nice trend trades. But remember, we're all looking for that 3 to 600, 1600, 2600 a day. And usually the 3 to 600, we only need 2 or 3 trades a day that can book a 5, 10, or 15, or a 5, 10, or 20, or maybe a 4, 8, and 12 ticks on the ES, which is 1, 2, and 3 point. Remember, 4 ticks to each point of the ES. We always say ticks in our room. Yeah, it's real easy. Each price movement of the indicator of the market is a tick. So we just think about the trades in levels of ticks, not so much points. Makes it easy. And you will see the euro is very good sometimes in the wee hours of the morning. Of course, we're talking to you on Eastern Standard U.S. time, but 2, 3 in the morning, and then sometimes it picks up a little bit just before the opening bell, like 6 a.m. to 9. But I think the majority of the volume is usually after that 9:30. But with any market, all markets don't trend all the time. We know that out of the 20 trading days out of a month, there's usually 5 or 10 days that are very good with these markets, and then there's another 5 days that are mediocre, another 5 days that are pretty much terrible, where you get a lot of, you just don't get any spreading, you don't get any trending at all, right? So again, a couple different setups. One is pullbacks after a crossover. Usually we're talking about the first pullback, and there's crossovers. The difference is there's crossovers with the trend line, meaning they're going in the direction of the trend line, and then there's crossovers which are counter trend, which could establish to new trends. In this case, we can see, now we really want these dots to spread out like they're doing, get that green trend line, and then pull back. And the spread oscillator down below here really gives us, and you can see when trades work, you do see the spread, right? And when trades don't work, what do you see? It doesn't spread. If this is going down here, as we saw back here at 11:05, there was no spread going down. So we know it's less likely to work. Okay, here's a pullback here. See that? No spread right here. See that black line is not above the blue? This might be better here. Let's go ahead and take an ask right here and see if that pulls up here. Might be a little riskier because the market was trending down, so now we're bucking the system, but let's see if we can get it here. Now, certainly at any time you don't like the trade, and we talk about controlling losers, well, you don't let it have to come back and hit your stop out. If we see something here we don't like, or the trade acts funny, we can usually use ebb and flow of the market. See how it's backing up here? Yeah, we can use this ebb and flow just to get out of the trade. Now the problem here is we have this shaded area, and the shaded area recommends or suggests it's possible chop area and possible reversal, right? And you can see here it's not, we talk about stair stepping. How come it's not stair stepping up here? Yeah, it did right here, and I think it happened so quick. It's just not continuing like the other ones are, right? So now we're in trouble, right? So now what do we do? Well, you can come here and cut your loss and take a small loser, right? And you can see the advantage of not taking counter trades when you're in a trending market down. And we use larger time frames, certainly like 5-minute charts and 60-minute charts, daily type charts to try to establish what the trend is. But let's say you can see here this trade comes up, a couple different approaches. One is usually almost all trades that go against you will eventually come back to the entry, right? And I think we're only a couple ticks out here. And if you don't like the trade, you can just get up here and bring your stop right up to the target, right? I mean, why wait for a trade to burn against you with a 10 or a tick stop out or whatever you're doing, right? Other people might drag their targets right here, right? I think this is probably good to get out of here. We can let it ride out here and see. Now, this is a great case where you see the indicator turning green here, and the indicator says stay with it. Now, we're not here to suggest that you can't take heat or drawdown to get the trade. We're saying if we notice there's trades that don't have drawdown, or little or no drawdown, why wouldn't we want to trade those trades versus having to take entries and then have to let the trade come back and see if it takes out some type of support before it goes up again, right? Yeah, and this is a great example of, if you want to get out of the trade, you just come in here and you just put your stop here and get out of the trade. You can say, why would you do that, Todd? Well, because, and you can say, well, there you go, the trade's working. Well, that's okay. If you went out of the trade, we went out with little or no drawdown. We don't want to concern ourselves with, we frankly don't care if we get out of a trade and it works anyways. We just don't have that problem, for one. But occasionally you do, right? But we know right here when we took this trade, remember it was bar close here, and let's face it, was the trend line green here? Not really. Was the spread really in progress? Not really. Really? See that? And then when you did take it, what happens? Well, you're getting it on this bar at stair step, and then what happened? The stair stepping stopped, and it just came against you. And what we're saying is if you get out of a trade early, so what? At least you're not taking a loser, and there'll be other opportunities down the road. So it's important for you to understand that, because most traders that we help with our room, and traders across the world, are always holding trades. And why do we have losers? Well, because you're holding a trade because you think it's going to win, and then what happens? It never does win, does it? And you take the loser. So this is a good way to control your losers. Here's a pullback right here. We can try it again here. But certainly we challenge everybody here that's listening to this video, and you'll see it with all sorts of edges. Remember, we're all trading the same markets, and the ebb and flow is the same for everyone. The key is, can you find an indicator that gives you an indication that there's more likely of a trade working than not working? And of course, here's a little bit of spread. This can be kind of tough here too. And at any time you change your mind, you can just come up here and just get out of the trade. It's that simple. Yeah, that there is always ebb and flow in almost every trade I looked at and the losers I took when I was learning, right? This says, I don't like this, put it up here, get out of the trade. That simple. That simple. Because we know winners act a certain way, losers act a certain way, right? So that's the key with trading. There is no secret. The best trading is good observation, good execution. We do that through understanding, of course, our edge, money management, mental framework, statistics, market dynamics, and focus and attention span. And if you have a problem in trading, it's going to fit in one of those categories. The nice thing is if you think about your problems and isolate your problems, you can usually come up with the solution to the problem. And that's what we do in the EminiTradingSolutions.com room. Okay? Okay, so I think that's good. I think we showed you the MCD indicator, the spread oscillator, how we use that to be successful in our trading. Now, certainly, you could say, well, you could have held that trade. Well, that's fine. I mean, we can always take the trade again. And certainly, when you're booking those 5s, 10s, and 20 tick targets, and I think that's pretty accurate with that euro here. Again, how do we know how far these trades go? Well, because we measure every trade that works and doesn't work, and we know through patterns of randomness and recording our data points what to expect and what not to expect. And that's really the key with trading. So you don't find yourself, again, in the old days we used to hold trades because the guy in the room said we should hold them, and yet the trade was never working, right? Here's another pullback right here. Now we talk about, does this happen pretty fast here? is the spread really in progress? Well, yeah, it's a little better. I mean, you got the green zero line, green histogram here, which is certainly good. Yeah, and if you miss a trade, so what? I mean, we have trade opportunities all day long. We don't want you to chase trades. We want to make sure you're there waiting, not anticipating, but waiting for the setup and waiting for the alignment of the charts. So that's really the way we want you to do it. All right, so thanks again for joining us here in the E-mini Trading Solutions. And until next time, folks.